Well, hey Andy, how are you? It's great to see you again. I'm really excited to do another video with you and talk about many things that you know from all your experience.
Well, thank you, Katie. I appreciate you having me on the video with you today again, and it's great talking to you.
Yeah, I appreciate your time. I really do. It's wonderful that you can take a minute and talk to me and take time out of our busy days. So last time we talked about the application process and the soft pull and then what really happens when somebody really wants to make an offer and doing a hard pull on their credit. But I
Yeah.
wanted to talk to you a little bit today about debt to income ratio. We hear DTI thrown around a lot, and I think it can be quite overwhelming for buyers to hear that and hear what their debt is and what that all means. And, we've talked about how student loans are now back to being having to be paid for starting October 1st of last year. So if you could just talk about debt to income ratio and how is that calculated and how does student loan debt come into play with all of that?
Yeah. Yeah, I'll be glad to. So, yes, that is a common question that we get from borrowers. We mentioned the term DTI or debt to income ratio, and I know that 95% of the people I'm talking to on the telephone or meeting with face to face don't understand it. So, the best way I know to explain DTI is just to say it is a percentage of someone's debt to their income. And so what we do is we look at gross income, and that's where a lot of people get thrown off. They think, well, I'm just going to use my take home pay. But that's not what we use. We use their gross income before any taxes, any 401k deductions, health insurance deductions, any of that stuff's taken out of the paycheck. And then we add up the monthly debts that I'm going to say show up on the credit report, but if there are new debts that would show on the credit report, we have to factor those in as well. Also, things like that are not going to show in a credit report, like child support, alimony, tax payments to Uncle Sam for back taxes, things like that we have to consider or count into a debt to income ratio. What we don't count in a debt to income ratio as far as debt's concerned is utilities. So we're not going to count cable, we're not going to count internet, we're not going to count cell phone, we're not going to count insurance, so your car insurance, health insurance, whatever kind of insurance you have, we're not going to count unless it's homeowners insurance. That is factored into a debt to income ratio.
And
And
this is
so
talking about buyers that are an employee with a W-2 at the end of the year, correct?
that's correct. I'm glad you brought that
Okay.
up. Yeah, because a self-employed borrower is going to be a different calculation. So that's a very good point. Thank you for bringing that up. And I'll try to just, hit that on a 30,000-foot level when it comes to self-employed borrowers and just say we're going to go through those tax returns. We're going to take the net income from business operations. There's going to be some things that we can add back to that income in order to determine what that income is for debt to income purposes. So, but yes, that's a great point. Thank you. But we're going to add up all of those debts, and we're going to divide the debts into the income to come up with a percentage. Typically, for someone with very good credit on a conventional loan, we want to see that debt to income ratio come in at 45% or lower. Now, we can go a little bit higher than that if it's an FHA loan. Sometimes we can go as high as 50% if they've got very good credit. And so, you know, someone may ask the question, well, what is very good credit? And I will just say this because I don't want to date this video and make it to where it's basically obsolete in 2 months or 6 months or 2 years from now, that credit bracket changes constantly depending on Fannie Mae and Freddie Mac's appetite and FHA's appetite for lending as well. So if they're tightening guidelines or tightening restrictions for lending, that 45% on a conventional loan may come down to 43 or 42%. FHA may come down from 50 to 47 or 45%. So, we have to kind of keep that in mind as we're talking about that. But that's generally what we look at. A VA is going to be a completely different deal altogether because we don't factor debt to income ratios in per se. VA is very unique in the respect that what they do is they look at residual income. How much money does a borrower have after all of their debts are paid from their income? And so VA is a different creature. We're not considering those debt to income ratios with VA. But yeah, that's kind of how that works. We're going to take the mortgage payment or proposed mortgage payment, and we're going to add it in with those debts and come up with a calculation. And that is a big, big, big factor on determining whether or not someone can get approved for a certain amount of money. And, there are little games that we can play. I hate to call them games because it trivializes the approval process. And I don't mean to do that at all. But there's ways that we can go in and run what if scenarios with debt that people have to say, okay, well, we could not get you approved at a $300,000 mortgage with your current debts and your current income. But what if you took this car loan that you owe 12 months on and you paid it down to where you only owe 10 months on it? Then we don't have to count that car loan as a debt on someone's debt to income ratio. And maybe that person would then qualify for not just 300, but maybe 325,000. So, there's ways that we can get in and run some different scenarios to determine if someone can qualify or to bump the amount that they can qualify up. And that's one of the things I love about this job is that, we're looking for ways to approve someone's loan. And if we can, someone says, hey, I can afford a mortgage on a $300,000 house, as long as we can get that person approved for that, it's not my place to tell that borrower, you can't afford it. And that makes my skin crawl because that buyer knows their own finances better than I ever will. So if that buyer says, I can afford a $300,000 mortgage, but we can't get them approved for that, now I have to say, well, I can't get you, you probably can afford that, but I can't get you approved for it. So let's play with these numbers a little bit, run some different what if scenarios and see if we can get you approved for that amount.
So let me ask you this real quick about the student loan situation.
Okay.
Is there, go back a little bit, please, for me and explain specifically on the student loans how that is calculated. Are you saying it's calculated the same as if it was a credit card? And then my other question for you, Andy, is roughly on all the loans that you work on, what is that lowest credit score that you can work with? And I know I don't want to box you in because I know that changes and I'm not
Yes,
trying to box you in,
that's
but
okay.
just to give prospective buyers an idea of what that really means, especially since we have lots of, not to go on a completely different topic, but lots of buyers are looking at the credit karma and those sorts of things, which is not the scores that borrower or lenders look at, which
Right.
is important to point out, but I don't want to take us down that road. We'll touch on that on another video. But I think it's worth it to just talk a little bit about the student loan thing and maybe just kind of the base uh, credit score that can be worked with.
Yeah. Yeah. So the student loan situation is something that we run across quite often now. And I will say, I've been in the business for a long time. And when I first got in the business, I might see student loans on 20% of the applications that I take or that I took at that time. Today, I probably see 20% of the applications that I take don't have any student loans. So it is a very big factor in people's qualifications. And what we do with student loans, since the payments have started back on those, is we look at the payment that is reported on the credit report. And if there's not a payment reported on the credit report, then we can get a printout from the student loan company showing what the payment would be or what the payment is, even though it's just not reporting on that credit report. And then we can use that, the payment that's listed on that printout. Or if a loan is in deferment, and this is very important, if a loan's in deferment, we still have to consider a payment on that loan. So how do we determine what that payment is when a loan is deferred? So each entity has its own way of or instructions for its own way to determine what the payments are. So Fannie Mae, which is one of the conventional lenders, says take 1% of the outstanding balance on that student loan and use 1% as the monthly payment for that loan. Freddie Mac, who is the other conventional lender, and FHA, they say you can use 1/2 of 1% of the outstanding balance as a monthly payment for that student loan debt. So we could go with a conventional loan and send that loan or sell that loan to Freddie Mac and have a lower total debt load for someone who has student loans just because of that, being able to use half of 1% of the student loan balance. FHA is pretty lenient on it with half of 1% as well. And then VA is probably the most lenient of all. And there's a calculation that we have to do for VA to determine what the payment is. And, again, don't want to get too deep into the weeds on that. But
Yeah, yeah.
if it does show the credit report does show that those student loans are in deferment, we still have to count that payment or payments for those student loans. And that's very important because I hear that a lot from buyers, and they say, well, I have 4 student loans, but they're in deferment. Well, we still have to count.
We still have to count those
Yeah.
student loans. And
Yeah.
then the credit report number, give me a bottom line number to talk to buyers about. And then we're going to continue this, Andy Gaglione, and taking and picking your brain from all your 30 years of experience about that credit score. And then we're going
Okay.
to go on.
I like it. So I'm just going to give you a number of 550 on an FHA loan. On a conventional
Okay.
loan, 620 would be the cutoffs on that. And again, VA says we don't have a minimum number. FHA also says we don't have a minimum number, but lenders put minimum credit scores in there. So we're 550 with VA as well. So just know if someone's sub 580 credit scores, we can do those loans. And we do those very well, by the way. And what I mean by that is we actually do close them, because there's some lenders out there that say, well, we can do this. Well, they can do it, but they don't do it. And I don't work with lenders like that. If our lenders say we do something, they're going to do it. So very important.
Amen. Amen. And I appreciate you and I appreciate your time. And
Thank
we'll
you.
be back on here talking again about different topics, and I look forward to it.
I do too. Thank you so much, Katie. I hope you have a great afternoon.
You too, Andy.
All
Thank
right.
you.
Goodbye.
Bye.